I'm Sam Moss from Gray Ghost Microfinance Fund. We're going to go in order. We thought we'd have Gil Crawford from MicroVest go first because of his fund, followed by Roger Frank, an investment banker from Developing World Markets, and finally, if there is time, Gray Ghost Microfinance Fund will actually have a few minutes at the end of that. As we go forward, I thought the two previous speakers get a great idea of microfinance and really laid a very sound work to kind of build upon. Yesterday in the San Francisco Chronicle, in the book section, there was something about the white man's burden, why the West's efforts to aid the rest have done so much ill and so little good. And while it's a scree on the World Bank and the IMF, one of the things that's, and whether you agree with that or not, one of the points, at least in reading the review, is that how important it is to act locally, of finding something small and develop it from the ground up. And that's actually one of the things that's most deliciously subversive about microfinance, that it really works from one person at a time and comes up. So the panel here is going to talk about microfinance, and Gil Crawford will be first up.
Thank you, Sam. I'm Gil Crawford from MicroVest. And as I was listening to Maria Otero today talk about the two distinct revolutions or grand steps in microfinance, I remembered back to February 1992 when we went down. I was representing a European investor to invest in Banco Sol. And at that time, there was really nothing in the entire universe of microfinance that was investable. It was the first time. And to be standing here at Google and talking about an investment class, to talk about true investments, I think it's only, 1992 is not that long ago. Things have moved very quickly, very, very fast. And today, Rachel asked that we speak about the quality of these instruments. That's the first thing. Secondly, about the financial engineering of these instruments. How are they structured? How should they be structured? The third thing she asked us to speak about is the risk-reward profile of different investments. And the fourth thing was, what are the existing investments in the microfinance space today? And finally, what do we see in the future for these investment instruments? But before I jump into those five points, again, the quality, how do we build them, the risk-reward profile, the existing instruments out there in the future, I think it's important to take a step back and say, why do we care? We're sitting here in Google. It's a company that's demonstrated the importance of scalability, of technological breakthroughs. Why do we care about financial instruments when we're really talking about small entrepreneurs in the developing world? Why in the world will we talk about something as esoteric as financial instruments? And I think the issue really was touched on initially by Maria, and that is that microfinance works. It's been proven to have enormous development impact, and I don't think anybody really debates the impact on the family, on the individuals, on the communities, and the economies. But what has happened is that there are two major gaps. One is an understanding of how to underwrite these loans and to do microfinance well. The second is a funding gap. There is still a funding gap, and that's because almost all microfinance institutions start out life with their left foot. They start making loans before they take deposits. And very few financial institutions in our communities start by making loans. They usually start by taking deposits. And so what the social investing that Jackie spoke about does is it's been bridging the enormous demand for funds in capital markets. Because when Maria and I would go out and we were trying to raise money for things like the Bridge Fund, we go into places like the World Bank, and I ruined a number of good suits getting thrown out of places like that. On my knees. Just the people's willingness to believe that the poor will repay a loan was very limited. It's beginning to change. And a number of us have come to the conclusion that capital markets are the only way to meet the demand. I think the estimate of worldwide demand right now is between 150 and 250 billion dollars. And right now today, world portfolios of microfinance and microfinance institutions 10 to 15. So about 7% of demand of theoretical demand is being filled. We know that the do-good organizations, the organizations that work basically with donations, cannot continue to grow as these microfinance institutions grow. When the loan size goes from $500,000 to $5 million, they simply can't do it. The small church organization is simply not large enough. And the large multilaterals that Sam referred to in the article, the World Banks, the Inter-American Development Banks, they can't hit small targets. And they haven't done a very good job, even if they could, of getting that capital out. The reality is, if you sum up the total of the investments that governments have made in microfinance institutions, it represents only $1 billion of the $10 to $15 billion invested in microfinance. They're not doing it. And so MicroVest and a number of other groups were created to demonstrate and to get capital from capital markets into the hands of commercial microfinance institutions. The first point that we were asked to speak to was the quality of the microfinance asset class. And that's first based on the quality of the microfinance portfolio. And Maria spoke in great length about that today. I'm not going to spend a lot of time on that. One thing that I don't think was mentioned is that not only are the loans repaid, and there are very low delinquencies on the loans, but also there's growing strong evidence that microfinance institutions are countercyclical. In other words, if there's a shock to the formal economy, the microfinance institutions weather that better. That's because they have a very atomized portfolio, many tens of thousands or hundreds of thousands of very small loans. And as Maria said earlier, there is no safety net in those economies, and so people are then thrown into the informal sector and have to earn their living that way. And so the microfinance portfolios tend to be very robust when there's a macroeconomic shock. I think you'll speak a little bit on the quality of the microfinance institutions and the lack of defaults, but there's very strong evidence that commercially run microfinance funds, microfinance institutions are not defaulting. This table here, I think, is important, and it shows not only that microfinance is good development, but that when you run a microfinance bank with adequate portfolio yields, that your return on assets is better than the return on assets, the profitability of most commercial banks in the markets we work in. Now, why is that important? It's important because there's also strong evidence that that shows that the best way to help the most working poor out of poverty is by doing microfinance commercially. That what happens is when you start running a microfinance institution like a bank, like a business, the cost to the end borrower drops, and it drops dramatically. And we've seen this in Bolivia where there's competition, Peru, Ecuador, and a number of other developing markets. When the level of competition grows with commercial microfinance institutions, the cost to the end borrower plummets, and the availability of credit goes up. Now, this story that microfinance is not only good development, but it's very good, the best way to do it is commercially, is a simple story. And there are an awful lot of people that are getting enthused by microfinance, and more people are asking, how can we invest in microfinance? And I have a couple of concerns about the market right now. One is that there is an awful lot of what I would call hype. We're coming off of the year of this being the year of microcredit or microfinance. There are a lot of new and part-time asset managers coming into business. There are a number of what I call captive funds that are managed by a network where they lend the money to their own affiliates. And in many instances, we're seeing the tenors, the length of time that loans are made to microfinance institutions, expanding a lot. And I think that it's very important for people who are beginning to think about the quality of microfinance assets to look for people with a quality track record and good equity protection in the funds. The second area that we were asked to speak about was how these funds are structured. And we've agreed that you would spend most of your time on that. I'm not going to spend a lot of it, but I've broken out the various investment vehicles. I think that there are two types of funds. One are our network, or what I call captive funds, and then there are independent funds. MicroVest is clearly in that camp. And then there are a growing number of investment bank groups that are structuring vehicles, collateralized debt obligations, for example, and there are a growing number of asset managers who are managing those. The third area that I wanted to speak about was the concept of what is the risk and what's the return for investing in microfinance. And obviously, the risks of investing in a microfinance fund or group are that you're investing in some very, very difficult countries. The countries that we've invested in span the range, but it's places like Georgia. We're in Mongolia, a number of Latin American countries. We happen to be a Bolivia-free fund right now. We left Bolivia before the Troubles, but this is one of the primary risks of being involved in microfinance institutions. You need someone who's had experience investing in those countries. There's currency risk, and then we spend an enormous amount of time, as you can imagine, on institution risk. Management, we do a due diligence with the team. We need to understand the underwriting, the information systems, the country's enabling environment, and understand how they are detecting and preventing fraud. And again, this comes back to having people who have a proven track record of reviewing that type of risk. The fourth area that I wanted to touch on were what are the investable instruments, and I've broken that into retail in the green and accredited in the tan. People in our fund tend to be investing either through their taxable accounts, through their tax-deferred accounts. We had our first $1 million IRA investment the other day, and or through family foundations. We felt it was very important because of where we came from as an institution to have a retail product. The Calvert Foundation was absolutely wonderful in helping us set something up. We have a retail product. We have about 120 investors in that product now. There are a number of others. There's the Calvert Community Investment Notes, which were mentioned earlier, a Oiko Credit, which is a Dutch ecumenical group, a very small fund. I think it's in, is it Michigan or Wisconsin? Wisconsin, yeah. Invests solely in Nicaragua. That's really the bulk of the retail market in this country. On the accredited side, by accredited we mean there's a legal definition of investors who have significant net worth and are deemed by the law to be able to make their own investment decisions. There are, I think, three big areas. I'm going to let Roger talk about the CDOs. We've spoken earlier today about the collateral and guarantee schemes. Citibank and Grameen have recently announced one, and there's one here on the West Coast called Microcredit Enterprises. In the funds, as I said, they tend to be broken into either captive funds that are lending to their own affiliates or independent funds, and here are a number of the other funds. What are we doing on time, Sam?
Keep going.
Okay. Within the investable instruments, I wanted to just give a little background on what we offer to the public. Our first fund is MicroVest 1. We recently closed our equity investment with roughly $15 million in equity. We're in the process of leveraging that with debt. We're offering investors between 4.5% and 6% on that debt. And we find that our target investors tend to be either social mutual funds, endowments, foundations, donor-advised funds, institutions, and accredited individual investors. There's a little bit more information on each of those on our retail note and our microfinance note.
The microfinance was available to individuals too directly?
Yes.
Accredited investors?
Only to accredited investors, yeah. And the minimum investment now is moved up to $300,000. We'll take $100,000 for 1 year, but we're really pushing that note up. One of the areas that we've found quite a bit of interest in this area is in the area of program-related investments. And this is a special code in the IRS which allows a foundation to count an investment as a program-related investment as long as it's not political and the project meets the mission statement objectives of the foundation. And it's an investment that no prudent investor would make. Would not make the investment but for the social objectives. And in other words, it is an investment that hits the social targets of the foundation, but it's one that they would not make because the risks are not fully understood of that type of social investment. It's an unproven area. And we're finding that there's quite a bit of interest in that area. Very quickly, our vision for the future, and this is the last section, is that the demand in microfinance is going to continue growing, particularly in housing, for other new financial services. Some of the large markets were initially untouched by microfinance but for a variety of reasons, government interference being the major one. We think that's slowly starting to change. We think the demand for cross-border financing particularly in hard currencies, is going to drop. There's evidence of larger demand for equity, local currency loans, of course, and long-term financing for housing. On the supply side, locally, we expect that there will be an increasing number of local and universal banks that will enter the market. We're seeing that in Peru, for example. More microfinance institutions will be allowed to start taking deposits. We are seeing, though, that most regulators are very reluctant to let a microfinance institution take deposits from the public, and that's going to constrain their ability to raise local deposit money. There are more second-tier institutions in the market, and I think you'll speak a little bit about that in India and in Africa. And there is more rediscounting of microfinance portfolios, particularly in India. We're not expecting to see any true securitization where someone takes the actual microfinance loan and bundles that into a securitization anytime soon. Now, others may disagree with me on that, but that's my prognosis. The vision for the future on cross-border financing, we see that there's going to be an increasing need for a third party to evaluate the asset class. Right now, very often when we are talking with institutional investors, there's no statistical evidence that we can provide of the behavior of the asset class. And I think it would be very useful if we had someone like Cambridge & Associates do a review of the default history of the asset class. I think there's going to be continued specialization in capital raising and in the asset management of this. There's going to be rating of the asset managers. And I think there's going to be a consolidation of unsustainable and part-time asset managers. So that is the end of my introduction.
As Sam had said, I'm Roger Frank. I'm with Developing World Markets. I've been working in the field for a couple of years. After a fairly extensive career on Wall Street and emerging markets, I'd like to introduce my colleague, Peter Johnson, who's one of the founders and principals, and if it weren't for him and his colleagues, I wouldn't be here, as it were. A little bit more about who we are. I mean, we've been very busy the last couple of years. We've raised over $150 million in global microfinance to date. A lot of that's been in debt, most has been debt, some equity projects. But what we do is really two things. Every project that we get involved with provides to investors a market rate of return. We've been involved with a couple of other projects that are much more socially oriented, but at the end of the day, to really move this asset class into the 21st century, frankly, we're trying to use greed as a motivating tool. You know, it's wonderful when we get together with the socially motivated investors and we hold hands and we sing Kumbaya and we push the chairs back. But what we're really trying to do in terms of the products we create is provide market rate returns so that people are financially attracted to the asset class, and by the way, they're doing a lot of social good with the use of capital. What we do and how we do it, I mean, essentially we're financial engineers. We've all been trained in the trenches of Wall Street. We know structure. We've taken these tools. We have a lot of experience in microfinance, but really what drives our business is a lot of financial creativity and a lot of financial engineering. Use of proceeds. I mean, during my tenure on Wall Street, I raised close to $1 billion, and it was always to lower debt or to buy inventory or to make an acquisition. In this case, everything we do is all about the people behind us and the people that you've seen in the slides from some of the other presenters here today. This is our commercial. This is a little bit about what we've done. I mean, getting back to sort of the Chinese fortune story example, we describe ourselves as a little bit like a Chinese restaurant. You want debt, we have debt. You want equity, we have equity. You want Latin America, we have Latin America. You want India, we have India. And we've really reached the point in our portfolio of projects that there really isn't a region of the world that we're not touching one way or another in terms of leveraging off of some of the financial models and the work that our predecessors have done. How does it all work? And thank you for the briefest of introduction. I mean, essentially it's called a securitization or a collateralized debt obligation. This is nothing new. This has been around for a long time, but what's different is that we're applying this to a relatively new asset class. Let's sort of break it down into its pieces. At its most fundamental core, there's a good cash flow. And what we do as financial engineers is to put a frame around that cash flow so that you, the investors, can actually get the cash on the other end. Now let's talk a little bit about what sustains that cash flow. At the end of the day, it's a couple of things. First and foremost, as you've heard, they're low default rates, but it's really about people like Amelia that Maria Otero spoke of, who are really driven to drive and to support their families. It's what keeps these default rates so low. So at the very core of this whole asset class are people who are motivated to improve the quality of their lives. The next level, if you will, are people, the servicers. They're the intermediaries, they're the Axiones, the Grey Ghosts, the MicroVest of the world, who are actually getting on the airplanes and talking to the managements and providing some of the technical support and services which really give these cash flows or make these cash flows sustainable because fundamentally they're good business. Then comes the special purpose vehicle. This is where we come in. As investment bankers, what we try to do is to take all these elements and pull them together and create a vehicle so that investors can get paid. And one of the things that we've gotten pretty good at in our tenure is measuring risk. In other words, how much risk are you taking on and what kind of returns do you want as an investor? What does that actually mean in practice? Well, if you look at the track record of the project that we've created, the typical yields range anywhere from around 5.5% to 9% on the debt side, and on the equity side with some projects that we've been involved with, comfortably mid-teens and even north of there. These are good businesses. These are dynamic companies that are growing at 30, 40, 50% at the end of the day. They have low default rates. When I was broking more traditional mainstream emerging market banks, never in my tenure on Wall Street did I come across financial institutions that have the kind of growth metrics that some of these MFIs do. So at the end of the day, that's the ultimate security that's going to be paying you back as an investor. And the way that we work it is fairly simple. Just imagine a pyramid behind me. The more risk you're taking, the higher you up are in that pyramid, the greater the compensation is going to be. I mean, we're involved with a couple of projects right now, and please see Peter or myself afterwards, and we can give you some of the specifics of what's involved. But the strategy here at the end of the day is to take the cash flows coming from the MFIs, put them into a structure that we work with servicers and people who are making sure that management is doing what they can, and then paying you, the investors, money. Another way that it works is to look at the model behind me. You simply start with the investors on one hand. We create a mechanism for it to go into a microfinance instrument, whether it's debt, whether it's equity. This instrument in terms fund the local microfinance institutions that are on the ground, and they in turn give the money to the microcredit borrowers who are in the local region. Now, that's not the tricky bit. The tricky bit is to make sure it works the other way. And at the end of the food chain, if you will, we make sure that the microcredit borrowers pay back the MFIs, who pay the interest on the notes, and ultimately pay you as the investors. Just as an example of the leverage effect, and I've used $50 million here because it happens to be the amount of capital that we're raising for one particular project. To us, one of the extraordinary things is the leverage effect. If you look at a portfolio of $50 million and you average about $1,000 per loan, you're talking about 50,000 microloans a year with an average maturity of a year. That translates into 250 million loans that are going to be created simply as an outgrowth of one particular investment vehicle. Well, that's the macro. Let's look at the micro. On the micro, what is it about? It's all about improving people's lives. As you can see from Jose here, you know, a blind entrepreneur, he's dramatically improved his own personal income. He's dramatically improved the quality of life for his family. So you take this and you multiply it by 250,000. That's what I call leverage. What lies ahead? You know, you've heard a lot of wonderful comments about the future. Just a few observations from ourselves. Clearly, we have other securitizations in the work, and you know, very much look forward to talking with you in more detail about that. We have some regional projects that we're working on, focused in on a specific part of the world. As Gil has suggested, there are certain regions that either have too much capital or not enough capital. I very often describe an MFI as the 7-Eleven. In other words, it becomes a distribution channel. There's a lot of credibility. You know, when you're trusting your money to an MFI, it becomes a wonderful, wonderful delivery mechanisms for other social services, such as healthcare. And we're working with a couple of groups that are exploring financing healthcare. One example, 50-year-old man needs a cataract operation for $80. You finance the $80. You have somebody who's not only working for 20 more years, but you have the caregiver that no longer needs to work with that person for 20 years. They, in fact, become a productive employee. And this is one of the new models that microfinance is exploring and thinking about. In terms of the last point here, we're at an extraordinary time, and this is why, frankly, I feel so honored and privileged to be here talking to this audience, because it's not just about transformation in the capital markets. It's about transformation in technology. If you look at the universe of MFIs of maybe 10,000 out there, it's really only the top 500 or so that are profitable, that are sustainable, that end up in funds like the ones that you see here with my colleagues, or end up in securitizations. As technology improves, it brings down the operating costs for these MFIs. It helps them graduate from the NGO philanthropically supported model to the point where they're self-sustaining institutions, and frankly, the philanthropists can travel more money down the food chain. You know, I was talking with somebody earlier. We were interviewing a prospective MBA to join us, and he said, I want to know a little bit about what your growth prospects are. And I paused for a minute, and I said, well, the way we figure it, there are about 2 billion poor people in the world, so we're going to be around for a while. Who are the investors? As I said, what we're trying to do is use greed as a mechanism to get people into this asset class. So fortunately, we've been able to bring some very prestigious institutions and organizations over to the dark side. We have a couple of the socially motivated funds that have come in. There are several of you in the room that are investors, and I'd like to take this chance to thank you for your support. We have family foundations and high net worths. But how does that tie into the audience here? Well, here's where you come in as Googlers. Chances are you went to a university. Chances are you have a mutual fund. Chances are you might have a family foundation. I guarantee you, I have spoken to at least 50% of those universities, those mutual funds, or those foundations, and knocked on the door and showed them the pretty pictures of the women and the children, and they said, that's great, but until demand starts to come from my clients, we're a little bit hesitant. We don't want to invest in this asset class. So let me ask you, talk to these people, talk to the people who are involved in your network, because when they start to hear it, they're going to remember that crazy guy who came in 6 months ago showing them the pictures, and that's really where we're going to be able to move the bar. It's not just me knocking on the door saying, you know, this is a good thing, but it's really got to become, it really needs to come from you. And with that, let me just conclude and say thank you.
We were founded in 2003 by Bob Patillo, a real estate developer who fell in love with microfinance and fellow entrepreneurs that were represented by the borrowers. He decided to sell his real estate company and he just committed $75 million to investing in microfinance. Our focus, while ultimately on the borrower, is actually on the microfinance investor. How can we encourage other investors to come in? And to that extent, we're a closed portfolio of right now $38 million, which will soon, we keep investing to try to get up to the $75 million, but to use that as a demonstration model of what is possible. We're willing to take risk. We have other friends here who are equally willing to take risk. Right now, what our focus is looking on secondary markets. How do you create secondary markets so that somebody deciding to invest in microfinance would think that rather than a leap of faith, there's a likelihood that you'll actually exit at some point in time. So to the extent that we can help create those secondary markets, that we're interested in doing that. And then how do you invest in equity? Gil has talked about that specifically right here. But again, it's a longer term horizon. That's the ultimate leap of faith, that something will take place that will cause an event so that you can exit in 8 to 10 years from now. We try to be catalytic. Again, we're trying to take as much risk as we can find. We believe that the underlying businesses are attractive, that with default rates at 98 and 97%, there are actually good business models that are on top of that. And then we also try to be active board members. We invest, you get us, sometimes that's good, sometimes that's bad. It's always going to be active, but that's our commitment, is that we'll try to be active in trying to demonstrate what the businesses are of the funds. Again, we only invest in funds. We don't invest in microfinance institutions, with one exception, which actually caused us to think we should invest in funds. Here's a list of the investments. The investments, again, are in the brochure out there. I'm going to highlight two things. We'll go through Axion Investments, one of our first. Maria mentioned that this morning. MicroVest on the debt and equity side with Gil. We have the developing world markets here as well, which we're on the most subordinated pieces when they close that. But I wanted to highlight Bellwether and Catalyst. Bellwether is a regional fund. We thought that there should be, in addition to having investment managers in the United States and Europe, if we could find investment managers that were based locally so that the second and third tier microfinance institutions could benefit from an experienced fund manager located closely, who could then not only provide capital, but also could provide investment advice and would know the landscape and help develop advisory boards. So Bellwether, created by the interim CEO of Basics, when the original CEO came back after a heart attack, he decided to set up Bellwether Fund. It is the first Indian-owned, in that all the equity is Indian. We actually are in there in preferred shares with Hivos Triodos from the Netherlands. It has the managing director from Basics and 3 investment officers with a total of 26 years of investment experience. Again, it's based in Hyderabad. It has the board of 4 Indian investors, as well as 2 foreign, one of which is Grey Ghost, the other is Hivos Triodos. So far, they have 8 commitments for $8 million or $3 million. There are 3 different kinds. It's not just MFIs. It's actually the non-bank financial companies, 3 NGOs, and 2 laterals and several startups. So it's a broad base of financial institutions in India trying to come in. They're going to open up the fund probably to another $1.4 million beginning later in the year, so other foreign investors can come too. It looks like it's being sufficiently subscribed on the Indian continent that it will be both a combination of local Indian investors as well as foreigners. The Catalyst Microfinance Fund. Here, we're trying to use 2 of the very distinctive and strongest MFIs, one in Africa, KREP in Kenya, with Kamanthi Matua, and in Asha in Bangladesh with Shafiq Chowdhury, two very charismatic people who are attracting second and third MFIs coming to them, asking them for advice. And they said, delighted to give you advice, wish we could give you capital, but all of our capital is tied up with their own MFIs. So part of this, the creation of this fund was to actually provide capital that then could be invested in the MFIs in East Africa, and then through Asha, more of Asia. There are 5, the investment officers, again, are based locally in Nairobi and Dhaka, oversight in Amsterdam, where Catalyst itself is based. They currently have 4 commitments, $2 million total. Two of those investments are in the Philippines, 1 in India, and 1 in Tanzania. This fund is still open, looking for investors, and they're coming out with their PPM, their revised PPM in the next several weeks. One other thing that we focus on, though, as a fund, we actually try to do the double bottom line investing. We're looking at the financial return first, as this panel has discussed, but we're also trying to measure what is the social returns there. We've come up with a criteria. It will be on our much talked about and never opened website here within the next month. It will be available. And we'll be showing you what our social return model is. We'll show you all the different components that we put into it. It's very idiosyncratic. It's not going to meet any other investor's criteria, but we'll show you what they are. And the 4 criteria we look at are innovation, scale, outreach, and financing. There are subcategories under each of that. Each of those 4 categories is with 150 basis points. We try to look through to the fund and into the MFIs to come up with, are they attracting private capital rather than the multilateral? How are they designing it? How many are women? What's the rural versus urban population that they're attracting? So those are the criteria that are important to us. It can come up with as much as 600 basis points of value. So in addition to the expected financial return, we then have a social return, and that helps us judge different investment opportunities as they come in, and then periodically we relook at it.
But I'm wondering more about combining things that are not sustainable, like the care of AIDS orphans or the education of kids whose parents cannot fund that, but looking for microenterprise models or community-based initiatives that can be bundled with things that would never be sustainable, nor would they be intended to be sustainable.
You want to start, or shall I?
I'll tell. Can I just tell one story? Your question is a very difficult one for a microfinance institution. We are looking to the ability of that financial institution to repay our loan or to give us the projected return on our equity investment. Where I see it happening in practical terms are the entrepreneurs themselves, who become much more a part of their community. They're making money so they can make their own decisions about where to spend their increased revenue on health, welfare, education, so forth and so on. But also, more importantly, they're learning to make decisions. They're standing up to the economic and bullies in their community because they have increased power through their business. And they become more a part of a nascent democracy. And this was brought home to me in Mongolia, a failed Soviet country. The woman had been a teacher in the Soviet system, and she was making yurts, the mobile homes of Mongolia. And she was really impressive. They diversified. They had a fully integrated line. They were making the felt that went around them. And I asked about some of the young teenagers that were on the site, and she said they're from the orphanage, and we're teaching them skills here. And it wasn't, a big dramatic gesture on their part, but I saw in that one company that what I've been talking about at polite seminars like this for years. I saw the actual practice of it, and I think that's going on in under-evaluated, appreciated ways all throughout. The 50,000 loans that you talked about, the 250,000 people who have borrowed over 5 years. That's happening, and those of us who are out talking to the clients, which we do every time we do a due diligence, we're seeing it. But I can't document it. I'm not a social scientist.
Great question. This is where we need to change philanthropy.
I mean, as I tell people, what we're trying to do is graduate MFIs who historically needed philanthropic dollars, so they're self-sustaining, and now let's take those philanthropic dollars and rechannel them into these enterprises that, in fact, need capital to get them going. So, you know, a lot of people are thinking about that and looking at it because for us, the issue is sustainability. And we're not there right now. You know, this is where contributions and foundation and grants and PRIs are absolutely needed to do the experimenting. And hopefully, you know, 3 years from now, there'll be another panel talking about, you know, sustainable health care for the third world. You know, we'd love to be part of that as we move forward and try to put frames around cash flows. But we're not there yet. You know, there are pockets that are experimenting and exploring.
And I think that the one other part underlying this is the importance of jobs and having income coming in, that health by itself and education by itself, if it's not coupled up with a job and a consistent income, it's going to fall through. And I think the intertwining of these three, and particularly jobs and the dignity of coming from, that comes from your creating your own job and creating your own income, actually makes health and education that much more likely to be successful. So I think that we're seeing them, to Roger and Gil's point, very interwoven, very difficult, but actually underlies, that's why microfinance I think is so important, because it provides the dignity and the income to allow the other things to be successful.
Just one anecdote which ties into that, and in fact, Peter, it's your story. Maybe I can just tell you about the woman in the breast exam that you, from Promo Hair, but it's a very powerful example, and maybe I'll just share because I've got the microphone, but when my colleague was down in, I think it was Mexico, the husband of a woman entrepreneur came up to him and said, "Thank you." And he said, "Why?" He said, "Well, before Promo Hair as a network allows the woman to pay back their loan, they have to sit through a health education program. And one education program was about breast exams. And this woman gave herself a breast exam and she found a lump and it was operated on and she was fine. So of course she's still working and her husband is still working. But you know, here's a case in point where they were integrating finance and using the MFI, as I talked about earlier, as a 7-Eleven distribution channel where there's trust and credibility, and it's still early days. We need to see where that experiment's going to go.
So the question is, what danger is there of a backlash for having a social impact rating, say 450 basis points or whatever for this or that microfinance institution?
Really good point. That's why we use it internally.
Yeah. Well, I tell you, sorry.
Go ahead.
Well, I tell you what my fantasy is. I have strange fantasies. We all know about carbon credits. My goal would be to come up with a metric to measure social performance and quantify it. So our notes might offer 700 basis points of financial return and 200 basis points of social return, and if you don't want those 200 basis points, you can sell them to Gil, and he'll start a social credit finance fund, you know, like they've done on carbon credits. I realize it sounds completely outrageous, but let's look at it from the point of view of capital creation. You have more people working, you're improving the GDP of the country, which means you have less of a social burden. So somewhere, you've got to be able to quantify the absolute dollars and cents from a pure economic GDP perspective, which in fact, money that the government doesn't have to spend, which is now supported by the private sector. So I don't know how we're going to get there, and it's going to take minds a lot sharper than mine to figure it out, but I'd love to have the problems of ratings and consistency and conformity. And, you know, Sam and his colleagues have done a great job starting and drawing the line in the sand and say, let's begin the process somewhere. Let's start with a common vocabulary, because in many discussions I find I'm involved with, the basic issue is, what are we talking about? Right. We're still at the point where we're trying to define the terms. I mean, there is one out in the top of the first inning in this game in terms of the capital markets and transformation of social capital. And all these problems, I look forward to thinking about in the future.
But I think actually the important part is actually creating a way in which you can talk about it, whether you use it as a valuation mechanism or just as a way to have a conversation. Right now, the social return is such a nebulous, amorphous thing that people tend to either avoid it or say, well, yeah, it has a lot of it. And so here is, if you can at least start bringing it to a point of, well, how would you talk about that differently, at least starts creating a language of discussion which otherwise people avoid it entirely. And so part of it is just, let's see if we can create a language. The answer may be we can't find a common one, but at least internally we can talk about it, and then we can actually come back and look at it as snapshots, because what was very innovative 2 years ago, Gil creating MicroVest and attracting private, well, there might be a lot of people. It's not quite so innovative now. So that it just may actually be progressive.
Back in 1996 or 97, Damian von Stauffenberg came over from the IFC to have lunch with me, and he said, I've been going to these microfinance conferences now for a year or two, and there are enormous debates going on between the Sustainable Financial Institutions School and the school that believes we shouldn't charge sustainable interest rates. And they're basically throwing chairs at each other in these conferences, and no one has any numbers. And he set about to create MicroRate, which is really the premier rating agency of microfinance institutions, and it has shown us a whole series of things. I'm not sure that you could have done your CDOs without the ratings. It's given us real numbers that we can talk about. It's completely changed the dialogues, but we can now show that microfinance institutions that have lower levels of subsidized funding actually offer their borrowers, the micro entrepreneurs, lower interest rates. There was no way we could have done that in 1997. And so I think it does propel the entire, I think your point's well taken, but I think you need to have iconoclasts and outliers like Reed
Have to have
College.
some visibility.
Yeah.
But that's why we try to create financial returns, because if you don't get any social returns, you're still going to get 8 to 9% on your notes. I mean, and that's, in its most base case, it's greed. It's applying to something that's measurable. It's this number of basis points over U.S. Treasuries, plain and simple. Oh, by the way, you get a social kicker. We're not,
In the absence of any more questions, which we're delighted to entertain, we want to thank you for coming and asking these questions and encourage you to continue the dialogue. Tracy Pettingill, who is over there in the corner, actually has created this Silicon Valley Microfinance Network, which meets monthly, the first Monday of every month. And any of you who are not part of that or not aware of it, talk to Tracy. It's a great way to meet other people interested in microfinance. So with that, thank you very much.
Thanks.